Hello everyone, welcome back, you're watching Boss Economics World. Once again, we're here to peel back the surface of the latest financial news to reveal the complex, and sometimes, frustrating realities hiding underneath. This time, we're going to talk about something that is shaping up to be the critical debate for 2025, and maybe even for several years down the line: inflation, interest rates, and the state of the US economy. What's at the heart of it all? A single familiar figure in the Federal Reserve. That's right, Michelle Bowman, one of the Fed governors, and her latest remarks have thrown gasoline onto an already simmering debate about monetary policy. So, let's break this down, shall we? Bowman is ringing the alarm about inflation again. Perhaps you've read that inflation did cool off through 2023, but now, as we enter 2025, there's talk that those gains have stalled, leaving inflation still uncomfortably high. What does this really mean for everyday Americans, and why is the Fed so hesitant about cutting those beloved interest rates? More importantly, how did we even get to this point? Well, buckle up everyone, because today we're going to satirically dissect how policymakers' decisions, or perhaps indecisions, continue to play Russian roulette with America's economic future. Let's dive deep into the monetary sea and unearth just how this Fed drama is impacting not just your wallets, but the entire global economy. Let's start with the inflation problem. Bowman mentions that the rate of inflation significantly declined through 2023. Well, that's no surprise if you've lived through it. Every main global economy felt the pinch. However, she then says progress has stalled this past year. Stalled, you say? Seriously? What happened to those glorious, transitory inflation claims we've been bombarded with the past few years? Bowman highlights that core inflation remains above the Fed's target of 2%. Now here's the kicker: the Fed's official inflation target has been locked at 2%, but we are still clocking in well above that. In fact, by November 2024, core inflation still hovered nearly 4.5%, and headline inflation itself fluctuated around 3.8% to 4.2%. This begs the question, what's going wrong? Well, if we were to play the blame game, perhaps we could criticize the overly optimistic assumptions made by the Fed back in 2020 to 2021. Remember those emergency rate cuts during the COVID-19 pandemic? The Treasury flooded with printed dollars. $5 trillion injected into the economy through relief packages. Combine that stimulus with broken supply chains and increased demand for goods and services, and voila, you have a recipe for inflation disaster. The reduced inflation Bowman celebrates is more likely attributable to external factors like easing commodity crises, energy prices stabilizing, and supply chains starting to normalize. But these are items outside the central control of the Fed. It's not that the Fed's monetary policy did wonders, it simply stopped feeding into the fire. Point to reflect on: the so-called inflation fall to a tolerable level hasn't happened because of some federal miracle, it's happening because global oil prices subsided and freight routes unclogged. At best, these policymakers are observers standing idly by, but trying to take credit. Bowman disagrees. In her words, the current Fed stance may not be stringent enough to contain inflation effectively. She's hinting that we might need more consistent pressure, meaning, potentially maintaining higher interest rates for longer. And here's where things get complicated. Contradicting Bowman's sentiment is the Federal Reserve's decision to reduce interest rates 3 times since September, by a total of a full percentage point. Ostensibly, the idea here is that economic data softened enough to allow for some monetary relief. Bowman's reservations, however, tell a different story. Looking at it critically, this moderation of interest rates is politically motivated. Given 2024 kicked off with America in pre-election fever, policymakers make their decisions with the political scales weighing heavily over their shoulders. A cooling labor market might dampen enthusiasm come election day, right? The cuts seem hasty. While they may feel justified by employers benefiting from lower borrowing costs, where's the risk? Higher inflation becomes an animal that remembers too well how to spring back when overly ambitious rate cuts take place. The shadow hanging over all of this is stagflation. That's right, the unpleasant concoction of high unemployment coupled with higher inflation, which, if you've been following us here on Boss Economics World, you know exactly what we're talking about. While Bowman claims inflationary pressures linger, the Fed, in managing moderate expansion in the economy, runs the risk of completely neutralizing the little restraining effect rates once had. Thus, you could see inflation soaring again, but harder to rein in, and businesses still retrenching, cutting jobs, cutting wages, tricky levers to juggle. Let's not ignore the numbers. As of Q3 2024, U.S. GDP growth was stronger than expected at 3.2%, but the labor premium faltered as jobs grew only by 1.7%, signaling possibly stronger price boosts coming in wages, which we now know is a major driver of sticky inflation. The labor market is still strong, but keep watching those cracks form. What gets overlooked in the debate surrounding rate cuts and inflation are the structural problems in the economy causing price hikes. Let's be honest, the Fed fiddling around with interest rates is one tool in the toolbox, but what they often forget to address is that fixing inflation long-term requires taking care of supply-side constraints. The competition for energy, raw materials, and newly realigned global supply chains can't be addressed by interest rate changes alone. The top global example? Look at the semiconductor shortage that kicked the inflation issue into high gear early on in 2021, and as of January 2025, it hasn't completely disappeared. Or take the housing market, currently one of the hottest debates in Washington. While the Fed can relax borrowing costs for middle-income homeowners, Bowman and other policymakers seem to ignore that America still faces a housing supply shortage of over 4 million units nationwide. Cutting rates might ease mortgage costs, but it won't build houses. In reality, real problem restraint cannot, and should not, revolve solely around monetary policy. It needs administrative, fiscal support. And at this juncture, politicians fancy stepping aside conveniently when struck by deadlines like re-election. Isn't that just rich? How could we forget good old Donald Trump? His specter hovers above the Federal Reserve's actions as if they're all wandering in his playground. When Bowman says we shouldn't prejudge what the new administration is preparing, there's no masking that we're bracing for yet another period of heightened volatility. The moment Trump's team walked through the door was historically fraught with a barrage of tariffs and anti-globalization whispering. Who knows what awaits this time? More interesting will be whether the incoming political regime exercises its influence over the Fed board reshuffling. Take proposals on bank capital, it's clear Bowman firmly opposed them. However, Trump's administration leaned more toward deregulation, wanting growth at any social cost. The fact that Bowman is a candidate for the prestigious role of vice chair for supervision under Trump's administration means a larger structural shift could quickly materialize, tilting Fed or bank regulation toward partisan goals once again. Truth is, come 2025, Trump might dispose of Michael Barr's regulatory restrictions and swing policies back toward lowered capital buffers, which gives large financial institutions more room to maneuver in risky environments. Could this once again stoke another overheated bubble? We haven't learned from past mistakes, have we? At the end of the day, you, the ordinary individual trotting through the financial quicksand, are left observing and enduring whichever blunders policymakers and central bank bigwigs make. Washington plays musical chairs with your financial security, while bankers and executives clamor with conveniently shifted priorities. As Bowman continues to send out cautious calls, don't forget that behind her words lies the tale of how fragile our economic architecture has become. We're no longer in a post-pandemic recovery mode. No, the bikers have left the gate, re-entering the inflation race, full throttle forward, unaware of, or perhaps intentionally ignoring the loose steering. Oh, dear Fed, your rate cut fumble might be more dangerous than you believe. Keep your eyes open and remain skeptical out there, or else the next blunder will be one you're caught paying the bill for. For Boss Economics World, sound the alarms, we'll keep watching the scoreboard for you all. Remember, like, comment, subscribe, and stay alert. The monetary drama is far from over.